All right, let's dive right in. We're going to pull back the curtain on one of the biggest ideas in real estate investing and find its so-called magic number.
So, picture this. You see a huge apartment building, a shiny office tower for sale. It costs millions of dollars. How on earth do you know in just a few seconds if it's actually a good investment? Well, turns out there's a tool for that. It's called a cap rate, and really, the best way to think about it is like taking a quick photo, a snapshot of a property's potential. It's not the whole movie, but it is a fantastic place to start.
So what is it? The capitalization rate, or just cap rate for short, is basically one simple percentage. It's designed to cut through all the noise and give you a clean look at the potential return you could make in 1 year.
You know what? To make this super simple, let's just forget about giant buildings for a second. Let's imagine you're buying a lemonade stand. Seriously, if you can understand this, you can understand everything else we're about to cover.
The formula for our lemonade stand is as simple as it gets. Step 1. Figure out your yearly profit after you've paid for all the lemons and sugar. Let's say you made $6. Got it? Step 2. You know the price to buy the whole stand is $100. And step 3. You just divide that profit by the price. $6 divided by $100.
And that gives you 0.06, or 6%. That's your cap rate. It means for that $100 you spent on the stand, you can expect to earn 6% of it back in profit in the very first year. Simple, right? That one number is your snapshot.
Now, here's the thing. A lemonade stand with a high cap rate, say 15%, might sound amazing, more money, but maybe it's on a shaky table in a bad location. Higher risk. A stand with a low cap rate, maybe 4%, is probably super stable and in a great spot, but your return is going to be smaller. It's always a balance between risk and reward.
Okay, so a cap rate isn't just one number that's set in stone. Out in the real world, these snapshots look different depending on where you're standing and what kind of property you're looking at.
And this brings us to the market cap rate. If you want to know if your lemonade stand's 6% cap rate is any good, you'd look at the other stands on the block. If they're all around 6%, you're average. But if they're at 4%, your stand starts to look like a great deal. It's the benchmark, the neighborhood average that investors use.
And this applies to real buildings too, of course. Different property types have different neighborhood averages. You know, those safe, steady city apartments, they might have lower cap rates. But big industrial warehouses, they can come with different risks, so they often need to offer a higher potential return, and that means higher cap rates.
And these rates, they're always moving around. They can change based on big things, like when interest rates go up, cap rates often follow. Or if the economy is booming, investors might accept lower returns, which pushes cap rates down. It all depends on what's happening in the world.
The snapshot is awesome for today, but what about tomorrow? Or in 5 years when you want to sell your investment? You have to plan for your big exit. This is the million-dollar question for every single investor. You don't just care about the profit you make each year, you really care about what you can sell it for at the very end.
And yep, there's a tool for that too. It's the terminal cap rate, or sometimes called the exit rate. And it's really your best educated guess of what the market cap rate will be for your property on the day you plan to sell it, down the line.
Let's go back to our stand. You've been running it for 5 years. Now you're ready to sell it to someone else. The terminal cap rate is kind of like the crystal ball used to estimate that final sale price.
So how do you use this crystal ball? Well, first, you guess what the stand's yearly profit will be in 5 years. Maybe it's $8 by then. Then you guess what the market cap rate will be, say 7%. You just divide that future profit by that future cap rate, and you've got yourself an estimated selling price.
Okay, so we've mastered the snapshot. But professional investors, they don't just look at a single photo. They want to see the entire film, from beginning to end. So let's look at the pro tools.
So just remember, a cap rate only tells you about 1 year. To understand the entire life of an investment, all the yearly profits plus the final sale, you need more advanced tools.
The first pro tool is the discount rate. Now, this one is personal. This is not the market average. This is the return you need to make it worth your time and risk. For a safe investment, you might want a 6% return. For a risky one, you might demand 10%. It is your goal line.
The second pro tool is the internal rate of return, or IRR. Now, if the discount rate is the goal you set before the game, the IRR is the final score on the scoreboard after the game is over. It calculates your actual total return, considering every single dollar you earned over the years and that big final sale price.
It really is that simple. The discount rate is the personal goal you set. It's the return you want. The IRR is the final score. It's the return you actually get. Want versus get.
And this is where it all comes together. The decision becomes simple. If your analysis shows the final score, the IRR, is going to be higher than the goal you set for yourself, your discount rate, then you have found a good deal. You've won the game.
So, if you remember anything from all this, just remember this. The cap rate is that quick, helpful snapshot. The discount rate is the personal goal you set for the return you want, and the IRR is the final, true measure of the return you actually get. We've given you the toolkit the pros use, from a simple snapshot to the full movie. So the final question isn't about the numbers, it's about you. Based on your own goals and how much risk you're comfortable with, what does a great deal actually look like? That's the real magic number.